Hi guys, this is Liz Threlkill with GDS Link. I appreciate everyone joining. We started just a couple minutes after the hour. We've got people trying to get on as we speak. So sorry for starting a couple minutes after the hour. I wanted to give a brief introduction of our speaker today from GDS Link. His name is Carl Spilker. Carl is the VP of Analytics for GDS Link. He's got over 20 years of experience in the lending space and has held senior leadership roles for companies including Ezcorp, Provident Financial Group, Dollar Financial Group, Lloyds, GE, and Experian Scorex. I am trying to make sure I can unmute everyone so that you can self-mute but jump in as you wish to ask any questions. And then, of course, with GoToWebinar, you can use the questions feature and post things in writing. I'll monitor that and bring any questions to Carl's attention. So without further ado, Carl, I'll turn it over to you.
Thank you, Liz. Shall I just kind of start wading into everything, or do we need one extra minute?
I think we can probably go ahead and start.
All right. Well, good afternoon. Thanks, everybody, for joining us through this presentation around navigating through uncertain times. More importantly, giving us a chance to kind of share our thoughts around future-proofing steps you can take now and leveraging some new information around bank transaction analytics that have come to light. So navigating through these uncertain times, we're all managing through the issues related to the COVID-19 shutdown and its impact on consumers as well as small businesses. Lenders are seeking to make an informed decision on how best to handle the impact of consumers' disruption in employment, such as reduction in salary, less working hours, or a form of a pay cut. Additionally, we've seen furloughs, loss of jobs are impacting the present and the future. Lenders are seeing the dramatic drop-off in application volume, shifts in that application volume they become accustomed to seeing, and increasing levels of fraud activity. I'd like to describe to you over this webinar some new tools GDS has developed along with our partners, Transaction Sciences, to convert this information into variables that can be quickly, with minimal effort, implemented into credit strategies using expert rules, leveraging our automated machine learning approaches to build and maintain the models, or execute it in something as simple as a dashboard format. These tools are presented to you as a strong solution to immediately address your needs that are being framed, or to assist you in the long term, allowing for your adaptation to future-proofing your portfolio from other economic, competitive, and potential threats. So first, I want to take a step and establish a bit of what I'm calling the new baseline. We've heard a number of economists that have and are in the process of predicting stunted consumer spending due to the coronavirus and thoughts of an upcoming recession. So by establishing a baseline, I wanted to look at a couple of critical decision areas, considered gaps for isolating information from these consumers I just mentioned that have been recently impacted. For example, income and affordability. How much was this customer's income affected? The range does make a difference in informing your response to his or her application. Some have taken a pay cut, some have had their consistent pay immediately eliminated from a furlough or a layoff. What information do we have at hand to make informed decisions around customers' need for payment deferments, forgiveness, or forbearance? What type of information is to hand about extending the loan, for how long, and with what terms? There's a lot of other things that need to be evaluated: skip pay, re-age settlement, refinance terms. What do you have to hand to help you better inform Accessing credit history can be a bit problematic in that the information may not be as updated and recent as you need. And when the market opens up, your new originations, what new information can assist in managing fraud and making better lending decisions? So I'm going to paint a couple things here about our traditional versus non-traditional data that's come to light. I've been and still a fan of credit bureau data and have no doubt this is one of the single significant sources of information about customers' behavior. Breaking down the CRA and 4,000 plus data points for ease of decisioning changed the market by eliminating judgmental risk and accelerating speed to decisions. A few of the negatives in the Bureau can be viewed as a bit of a crowd-based view: recency, timeliness of the data updated on the file, managing the collection of information from numerous institutions, quality control of the data, businesses' adaptation capacity, report to the bureaus. Some estimates that a lot of this information can be delayed by up to 30, 60 days to find its way into the file. That is one of the reasons I added this additive, this plus sign. In addition to new data source, bank transaction data is clean, comes from a single point, the bank, and it provides some rich customer history. The customer consents to accessing the data for you to use it. I've run into a few incidences where errors have occurred, but have not resided or lasted for very long. A solution we have designed mirroring the evolution of the credit reporting file is to augment this data source with our own data engineered features using the customer's recent transaction history, showing their overall cash flow, affordability, spending, savings, and other insights. So we've developed a premier suite of trended information received from data feeds and collected from bank aggregation providers such as your Plaid, Yodleys, Cashflow Solutions, Finicity, Microbill, to name a few. We've normalized the data so that it is the same regardless of provider. And the functionality combined multiple bank accounts into one feed. We built these tools to convert this information to variables that can be easily and quickly implemented. Our analytics capabilities has built a number of expert rules and machine learning models around fraud and default using only BT data, or in some cases integrated with our clients' internal application behavior and credit reporting sources. And I'll share a little bit more of some detailed insights, give you some view of what's kind of bubbling to the top when we do look at specifically only bank transaction data on the next slide. We developed the ability to deliver high-performing analytics into institutions' environments to make it simpler. This does not require significant integration into your legacy system outside of API feeds. Not all consumers have credit history, referred to in many cases as credit invisibles. The models we've built serve and address this universe, many of which do have bank accounts. Another sizable segment is a large population with robust credit history, but grouped into pools of deep delinquencies that are nearly impossible to distinguish that behavior. This product adds lift in bringing forth the better performers. Additionally, we're able to address that prime credit universe. This new information is additive and providing incremental lift in limit management, price optimization, cross-sell, upsell, and managing your campaigns, loyalty campaigns. One of the pieces as we talk about inflation is adapting your scores to what I call a bit of that score inflation impact. Most lenders will be seeing an impact of their existing models and scores requiring adjustments across the full distribution. Our solution provides some enhanced actionable data to improve that decision on your behalf. So let me talk to you just in general, some of the things that we found after building, we've built upwards to about 15 to 20 customized models using the combination of banking transaction data, for small businesses and consumers, or integrating with other external data. But I'm just going to kind of highlight a couple of things popping up specific to what's being brought in from our customers' banking transaction data. These features have made their way into either a fraud or default model. So some interesting thing, higher levels of bank activity denote some lower risk. Recency, the amount of overdrafts, intuitive, do make their way into signaling positive risk, and that it's been a long time since they've had an overdraft versus some recency. Cash flow is something that's really coming in. The high volume of cash into accounts during and around paydays versus lower volume can denote the customer's ability and cash flow coming into their account, and it signals good characteristics for good risk, and that lower amount for lower characteristics for higher risk. There's a couple things that we were able to tease out with our features is ongoing consistent obligations. So the amount of obligations associated with a rent or telephone bills or utility bills that are consistent are intuitive, in that the more that spend that there is with inflow, the better some of these customers can manage that account. Another thing that's of interest is the percent of weeks with zero or negative balance versus longevity with zero and negative balance are pointing some indication of these customers having some stress into their risk. And simply that measure of obligations are related to some consistent impact to their account. And the higher that is as a percent of their outflows is denoting some negative value to their credit risk or fraud risk in this case. So I'm going to speak to a couple places where you can leverage this information. As I mentioned, here is data that is available. The minute this is pulled down, you're going to have a deep insight into your customers' past 90 or 6 months of banking transaction history that can be augmented with maybe a little bit of some delayed history from a credit bureau report. But one of the things we've immediately found by taking this data for small businesses as well as consumers is we're able to reduce the impact of manual underwriting. Our ability to reduce and eliminate high levels of fraud exposure is brought forward with this new data. We add this type of information, or even by itself, has got tremendous increases in your ability to predict risk and improve your models for fraud, account management models, and collections. There's another piece that kind of pops up, which is the improving your account due date alignment. You know, a lot of people generally are on a bi-weekly, 2 times a month pay cycle, but in some cases, you know, government employees may be paid on Tuesdays versus Thursday, Fridays. You may have multiple accounts using that bank, and in these cases, you're able to identify and line up when that cash flow is coming in. So you've got an idea of where you line up to reach out to your customers for payments, and when you can identify when that amount of cash is in those accounts. You can leverage trigger features to identify behavioral changes for customer service, for cross-sell and collections. Knowing during your conversation where the status of their cash flow and affordability is at the time you're talking to customers gives you some added ammo to help and address their needs. I'm going to spend a few seconds here, a few minutes, sorry, on talking about future-proofing, steps you can take now. Your ability to access customers to leverage this new data will definitely help you make more informed decisions, validating income, ensuring the due date, identifying the time when there's positive cash flow in the account. We're able to notify you at that point in time that consistent biweekly payments have been entering their account. They've disappeared in the last few weeks or have been dramatically reduced. Where there's limited information from your third-party sources, you now can enrich that. Where there's no information, you now have an alternative, i.e. those credit invisibles. I've mentioned that this isn't necessarily just for the high risk. We're gaining lift on the positive, the lower risk end of the credit spectrum. So you're now able to adjust and improve your line assignments and pricing for good customers, and you can respond to a better offer. The income and affordability is a key piece, and it's one of the things that we've been tasked with attempting to find. And you've now got a strong line of sight to overall cash in and cash out. The movement into that account is definitely contributing with your ability to identify some questionable risk, questionable fraud, and more importantly, adds value to improving your decision making. We're leveraging an automated machine learning and monitoring solution. We're talking high volume daily transactions. So our ability to offer a subscription-based product in which we're developing and continually monitoring, validating, observing population stability, population shift, unlimited model retunes and rebuilds, and access to data scientists allows us to help you stay on top and maintain the most up-to-date, strongest model that you can use for your decision. So these are some steps that are available now. They're responsive, and they'll set you quite well for future proofing to adapt to competitive and other economic impacts that could be impacting the market. So I've kind of finished that up. I would love to get some questions and open up the dialogue.
Carl, can you hear me? This is Matt Hoops at MLA.
Yes.
Just wondering if you could walk through a little bit more of your discussion on income verification that I think was on page 7. Just give us a little more detail on what you all are looking at there.
The bank verification?
Yep.
Yeah, so there's a couple things. We've got a number of KYC features that people will add into their application process. We add a second layer that ensures that that account applicant is matching up to the bank account. It also ensures that bank account's a valid active bank account. And we're also able to add another layer, reach back into historical transactions to ensure applicants associated with that, which is another bit of but great question, thank you.
Carl, we do have one question coming in via chat, and it says, how frequently should the information be refreshed? And I'm sorry, I want to let folks know before you answer that, Carl, and I'll repeat the question again. We were getting some feedback, so I did mute a couple of things. If you have a question and you're not able to get yourself off mute, please use the question function on the GoToWebinar. But the question is, how frequently should the information be refreshed?
Right. That's a great question. And one of the pieces is it's how often do you seek to be able to reach in and understand your customer? So we'll have some clients that want to use this to help manage and improve a customer's credit limits and maybe adjust their limits over time upwards. So they may want to look into that account bi-weekly. I found a monthly refresh is very good in that it allows you at that time of refresh to add to, and I'll give you an example, at the time you acquire or your first setup of that account, you may have 90 days. You've now got another 30 days added to that. And you're seeing signals of cash flow dramatically dropping off. That refresh can occur when someone reaches out to you through customer service, and it gives you a chance to do that refresh. Your customer service agents be automatically updated with this information, and or collections folks. And now you know that that individual's pay has not gone away, maybe has been reduced. And that's going to help you in setting your deferments, maybe some holidays to give people some breathing room, particularly in this particular environment. And that decision would be different than when you see somebody that completely lost their job and that pay or that consistent income's dropped off to zero. So it can be a proactive refresh or kind of a consistent account monitoring refresh, and around 30 days, I think, would be optimal.
Thanks, Carl. We did have one other question come in, and I kind of think you touched on it. You know, someone asked as maybe a follow-up to that, can you change your models every day or every week as needed? Is there a limit? I think really the question is there a limit to how many times you can change your models?
Yeah. Yes, that's one of the benefits is people, as we lean on machine learning like models, and as we're introducing high transactional volume data, we prescribe to constantly monitoring, so that if we are seeing some drift, some unusual transition of these variables and the model starts drifting, that we are in a position to update and retune that. And more than likely we'll be retuning more often because we want to keep at a very high level of predictability and consistency.
And then we've got one last question on chat, and it says, what performance difference are you seeing between models that use other data sources versus use bank data as well?
Generally speaking, we're seeing about a 25 to 30% increase across the score distribution by introducing this data to the equation. As I described earlier, a lot of the third-party data, might be considered stagnant in that it may be 30, 60 days delayed before things get updated. Two, you're now introducing what I call a bit of the other side of the balance sheet, more that positive cash flow, the activity into the bank account that is associated with the account you're drafting funds from or putting funds into. And so by introducing that, as I mentioned, model speak and performance, it's been about a 25, 30% on average consistent lift. We've seen in some cases significantly more.
Okay. We've got a couple people typing too. So Carl, in terms of that, you've got some use cases in terms of that lift and so forth as well too. Is that correct?
That is correct. We have some generalized use cases that we've kind of gleaned out of a number of analytics that we've done around this. Some simple expert rules, as I described earlier. In prior 4 months, we've seen consistent repetitive inflows. In the last 2 weeks, those inflows have dropped off by some factor of half, if not gone away. So a little bit of expert rules. You can action those accounts aggressively or differently.
Okay.
More complex models that we built.
Okay. Here's another one. Is it better for origination or account management or collections? So I guess is leveraging this data better for one of those versus another?
What I've seen so far is predominantly for originations. It's helping to differentiate greatly. For account management, it's at what I'll call additive, in that your existing behavior being augmented with some third-party information to allow you access into their affordability is probably the second strongest lever. And we're just beginning to nibble around the edges how we use that for upsell and cross-sell. But you do have that as an account monitoring like tool. And then for collections, we see actual improvements because we're aligning things a little bit better around people's cash flow coming in to be the first in line to get payments. So that is proactively assisting collection.
Okay. And we've actually got two more questions. One came through asking, is the data being used for adverse action? If so, how are consumer notifications and disputes handled?
Yeah. The data, what's the word? I can't do I understand the legal aspects of this as far as what's being done on adverse actions, but you'd have to customize and respond to that. We don't offer that service. I don't want to say I don't know, but I do know some answers that are not legally qualified that it would probably behoove us to have a one-on-one conversation after this call.
That's great.
To better answer that one. Because it's, as I mentioned, or I may not have mentioned yet, we've seen about 30% of some of our folks we've interacted with are actively using this in a underwriting process and have solved that piece. And others that are actively looking at how best to use that in that, disclosure mode.
Okay. If you want to flip to the slide, Carl, we've got one more question. And while you answer that, I'll ask it just a moment. If you want, yep, there we go. Just wanted to flip to the slide with Carl's email address in case anyone wants to follow up with more questions. And then we've got one more. How long are people taking to go through and obtain a relationship with a bank data provider, kind of do the retro study, I guess, build a model and then implement, and then what are the typical resources needed?
Okay.
So it's kind of a mouthful. Let me know if you need me to repeat it.
Yeah, what we found is if they've been pulling this data and using this data in the past and want to super enrich it with some of these additional features, we can get through a retro exercise very quickly. We're talking under 30 days. To get connected to the solution and have it actively presented in that environment can be done within a week. To deploy the models are what I call a bit reliant on that lender's current infrastructure and environment, and that could range 2 weeks to a month to 6 weeks, depending on their IT and infrastructure and ability to deploy these.
Okay. And then one more that came through, is there a limit on what data sources can be leveraged?
There is not. Matter of fact, I think from a quantitative, put my quantitative hat on, the more data sources that you can look at and choose, the better your decisions will be and the stronger that those models will operate. And a lot of those data sources may not be needed after you've introduced some new data. We've actually, in some cases, have found that the banking transactions replaced the value of some of the other third-party sources folks have been using. So you can take out some expense and add more value.
Okay. And I might have one more coming in. I see something typing. Okay, the typing bubble went away. So I think that's it. Some really good dialogue and questions. I think Trish is going to send out, Trish and Nat will be sending out the deck for everyone. Again, Carl's email is right here for follow-up as well. If you have more questions or want to talk about some of those use cases and so forth and the lift that they're seeing. But want to thank everyone for joining. Thanks to Nat and Trish for helping us to pull this together. Carl, do you have any closing comments?
No, I just greatly appreciate you guys giving us a chance to kind of discuss this and go over this detail. It's a tremendous change and add that we've been seeing and looking forward, I hope, to have some conversations with you about this. Thank you for the opportunity.
All right. Thanks, everyone. We appreciate your time. Enjoy the rest of your week.